This is the Chapter 1 theoretical presentation for Financial Statements and Analysis, Evaluation Approach for Business 430, Spring 2014. As an introduction to security analysis, it's important to understand where we are going. And we're going to discuss in this chapter the jobs for various financial reporting professionals, the sources of information that these professionals use, and the financial reporting environment. So who does security analysis? Take a minute, hopefully you've read Chapter 1 by now, and think who you know or who you would think does security analysis. Buy-side and sell-side analysts do security analysis. Now, just by way of understanding, buy-side analysts are those that represent buyers of assets or companies. Sell-side analysts are the analysts that represent sellers of assets or companies. So in our environment, Apple would be a buy-side analyst or a buy-side company. A company like Instagram or Tumblr or some of these others would be, they would employ a sell-side analyst because they're trying to sell the company. They're smaller. Some of the others that do security analysis: investment bankers, corporate finance specialists, mergers and acquisition analysts, individual investors, venture capitalists, employees, and potential investors. So everyone should be doing security analysis. Some professions do it better than others, but we should all be familiar with security analysis. So where do these analysts get their information? One of the key areas they get it from are financial statements. Public companies are required to file public financial statements, so that's where a lot of the information comes from. You can get disclosures from the firm or company that you're doing analysis of. Stock analysts, those that are paid to write reports on publicly traded companies, they provide some information as well. You can also get newspaper and magazine information from periodicals and other public sources of information. Some of these other sources of information are industry experts, economic data, purchase data that you can buy, competitors and customers, and competitors' annual reports. Financial reporting environment. Let's understand that managers need a way to convince investors into the fairness of their financial reports, that they're not just making these numbers up. And so they've come up with some rules and mandated audits of these publicly held companies to help individual investors and the public community get some comfort around these numbers. So analysts and those doing the analysis rely on generally accepted accounting principles, or GAAP. And this is what I call the language of finance. Accounting is the language that's used to be able to understand and have a common understanding of certain terms and analysis and strategies that are used in compiling the financial statements of a company. So GAAP is that accounting information and standard that is used, and it ensures that information in financial statements is useful to investors. And analysts understand that information can't be perfect. You're trying to somewhat understand what happened in the past and predict the future a little bit, so you're trying to make some judgment calls, and that's where these generally accepted accounting principles play. The content of a financial report is determined by, first, the managers of that firm or company, then the auditors or the accountants that are making the judgment calls on the information that's provided to them. Regulators, both state and federal regulators, determine the content of the information as well. One of those regulators is the Securities and Exchange Commission. This is a large federal agency that's been charged with overseeing the financial industries within the United States. And they have the power to prescribe accounting methods. That's where this generally accepted accounting principles comes from. And they can specify disclosure requirements. They can say to a company, this is what you have to tell people. This is what you have to disclose to the public so we can make a fair and complete analysis of your financial health. FASB, the Federal Accounting and Standards Board, is responsible for establishing accounting standards in the U.S. And they issue pronouncements when things change or they come up with a new understanding of how to deal with a certain situation. They issue a pronouncement. And they give interpretations because, again, as we covered previously, finance and compiling financial statements is not an exact science because you're trying to understand what happened in the past and what is potentially going to happen and be used in the future. And that's where these interpretations are helpful from FASB. FASB does not have the authority or responsibility to enforce compliance with these standards. They just set them out there, but they can't force anyone to use them. The auditor, this is one of the compilers of the information. This is an accountant that is a certified professional accountant as well. They are responsible with determining that the financial statement methods are consistent with the generally accepted accounting principles. And they compile all the information that the company or firm provides to them and structures them and presents them in the format consistent with the GAAP standards. They verify the financial statement assertions. If the manager is saying, hey, we've done this, they look for receipts and make sure to verify that the information that they're being provided is somehow verifiable. And they try and limit distortions to financial reporting so that they can give some consistency of information across all companies. They also run tests of the firm's or company's internal control system. So the basis of the information that an auditor gets comes from the company and the company's management. So they run tests to make sure that the information they're receiving has some integrity. So they will run tests to make sure that the information has some controls in place so that bad information isn't getting in or fraud isn't occurring or that the numbers aren't being made up. So now let's talk about security analysis in 4 phases. First is business analysis. Second is financial statement analysis, forecasting or projecting the future, and valuation. Security analysis process. You can see it here. You start with the business analysis. You need to understand what the company does, how it generates income and revenue, and then what its expenses are. Then you can go back in time and look at what's happened in the past using generally accepted accounting principles, utilizing those financial statements. Then you can analyze those financial statements over a period of time so that you can see how they have done over that period of time, which will help in your business analysis. Then you can forecast some things. If they've done a certain thing in the future, you can put some probabilities about their ability to do that in the future. Maybe it'll be better, maybe it'll be worse, but then you can make some assumptions about the future, and then that will give you some ability to conduct a valuation analysis back to today. In business analysis, the analyst tries to understand the key business drivers of the firm. How do they generate revenue? What expenses do they have? How do they capture income? What is their income? All of these things are what the business analyst is trying to do, is make sure they understand how the company operates. In financial statement analysis, the analyst is trying to use the historical financial statements to learn about the firm and understand the firm's profitability, growth, and resource needs to potentially improve that growth or continue that growth and profitability into the future. Now in forecasting, you're using both of those, the understanding of the business analysis and the understanding of the financial statements, because the financial statements give you the historical view of how the company's been performing to now project and predict future financial results, because that's what you're trying to determine, is what is this company going to be worth in the future so that I can determine what I need to pay for it today. And in valuation, the analyst uses forecasting and evaluation model, a way to present value or bring back to today the value of a firm's equity or the value of a company. So in summary, many people do security analysis. You may not think that you do it, but in a very rudimentary and simple format, you do financial and security analysis. Analysts rely on a variety of sources. They can pull information from the newspaper, from magazines, from the internet, from conversations with buyers and competitors, and in conversations with the company. They rely on generally accepted accounting principle financial reports. So they use the historical financial reports of these companies and other companies in the industry to get a better sense as to how these companies are performing. And lastly, analysts use 4 phases in their security analysis. They start with understanding how the business operates, reviewing the financial statements, forecasting or projecting the future, and then using a valuation methodology to be able to take that information from the future and bring it back to today to come up with a price or a value that you'd be willing to pay for that projected future or predicted future. So that's an introduction to security analysis. If you have questions, please review the chapter that these slides correspond with.